Morning, market chameleons, and my favorite chameleon soon to appear, Dimitri Pargamonic. Welcome, Dima.
Good morning, Will. How are you?
Awesome. It was an awesome webinar last night with Raj, and it looks like we've your thought process is to kind of carry over the open interest this morning. Is that what we're going to discuss, open interest?
Yeah, I think we'll take a look at the open interest, and one of the things we'll do is take first scan for open interest that had a large significant increase from the previous day. We're going to do that scan, and then we'll take a couple examples and see what we think may have happened and if there are any type of opportunities we could look for based on the open interest change and what we think happened yesterday in the trading to increase that open interest.
Excellent. Let's start with the disclaimer. You all right with that?
Yep. So good morning, everyone. Before we get started, keep in mind, Will and I, Market Chameleon, we're not registered investment advisors. We're not broker dealers. We're not telling you what to do. We're just sharing ideas. If you need professional help, call your broker. That's what they're there for, to help answer your questions and provide you with guidance.
Great. All right, let's roll.
All right, let me share my screen. So before we go to the open interest, we'll quickly take a look at what's going on in pre-market hours. As usual, if there are no questions, I'm going to jump to the to that open interest scan. So these are stocks that are trading in pre-market hours. We have the most active list, biggest percentage gainers, biggest percentage decliners today. And down here, I'm coming down to see how many made our percentage gainers list. That's 126 stocks, 36 on a percentage decliners list. From that perspective, looks like a more bullish bias at the open. We're also going to take a filter and see what's going on in the higher market cap stocks and if the situation there is similar. So I'm going to take market cap here, filter, stocks 20 billion market cap or higher. Again, here we see 42 made the percentage gainers list, 3 on a percentage decliners list. So from that perspective, looks like we're setting up for a bullish bias at the opening.
It's interesting for both those lists, and I haven't looked in the pre-market. The coins, the current cryptocurrencies must be moving higher or something, because I see Coinbase is up in the larger cap, and then the smaller cap, there were a bunch of those. Riot was up, MSTR. It's interesting.
Yeah, so we could see here a little bit of a pattern where you see Coinbase, that's the crypto exchange, up 3.2% today. 40,000 shares trading in the pre-market hours. So I wouldn't say it's huge amount of shares, but still up 3%, 40,000 shares. It is a $232 stock. So something to keep in mind. You said there was another one. Which one?
Well, I was just saying, when you were looking at the overall market, the movers at the beginning, I think MSTR was on the list, and
right. So Riot. A lot of these Riot, MSTR. Yep, these are also in the crypto space, right? So
I think MSTR is that unique. I think they're a software company, but they were one of the first. The CEOs adamant about holding any extra cash in Bitcoin. So it's basically been mirroring the moves in the crypto space.
I think that this MSTR is probably one of the biggest holders of crypto for public company, right? Like we have a couple other public companies that invested in crypto, like hold crypto outright, like Tesla, but I think Square,
maybe even PayPal.
Yeah, but I think that they've actually kind of made it almost their business model to raise capital and hold Bitcoin for long term. So, I'm not sure what that news is. I haven't looked at it, but there is, at least from just scanning here, it does look like a lot of these crypto-related securities are doing well in the morning.
Yeah, actually, Michael McRae on the YouTube chat is saying Bitcoin futures are up almost 6.818% in the morning. So
they're moving in sympathy. If there are no questions, if there are no other questions, or comments on the pre-market. I'm going to jump to the open interest just to have more time to concentrate on open interest. Will, let me know if you see anything that.
Yep, you can move on.
Okay. So I'm going to go here on options. We're going to take a look at the open interest analysis here, and I'm going to look for by option contract. So you have a couple different ways to look at open interest. We could look at open interest overall, using all the option contracts, open interest by expiration, if there's a big jump in expiration, or we could go all the way down to the specific option contract. That's what we're doing, is looking for a specific option contract that had a large increase in open interest. And when we talk about open interest, there could be a lot of volume in a particular option during the day. And when you have a lot of volume, it's possible that people are buying, thinking that the option will increase or decrease the same day and then close out of it before the close. And just because you have a lot of volume doesn't mean that the open interest will increase the next day, because people can be closing out of their positions same day. There could be a lot of volume, and there could have been a lot of open interest at the opening, based on prior positions, and a lot of that volume during the day could have actually resulted in people closing previously open positions, and that open interest could decrease. But today we're looking for where there was volume the previous day, and the next day open interest gets reported based on end of day trade settled trades. So the next day we'll see how the open interest changed, and we're looking for a big open interest increase. And the idea behind it is if there's a big open interest increase, whatever that volume was, people are still committed to the trade. They haven't closed out of it. They're still in it, so they must have some conviction in the trade. Of course, there's both sides to it, but what we're trying to do is kind of see what the story is, and maybe looking at those trades, where do we think the advantage is, or potential edge is on that side of the trade? Because there was a big open interest, there might be some after effect the next day. There might be more trading going on in that option, or it's going to impact other options, because if you have big positions open, the implied volatility could be pushed up or down. Okay, so that's the idea. So let's first start out isolating which option contracts looks like they had a big open interest increase. So I'm just going to kind of go here to my presets to make it easier. And here I have large open interest increase. I'm going to select this, and this will just pop up my initial saved filters. Okay. And here, what I have is, first I look for a stock that's above 10 bucks. I don't really look for options in low price stocks. 10 bucks might even be a little bit low, but let's just set that at least to 10. And I'm looking for open interest. Now, an open interest there's two ways to look at it. There could be a big open interest increase, but is it big relative to this specific stock? So some stocks like SPY trade a lot of options. Their open interest can change by a lot from day to day, but it might be normal for SPY, but for different stock, an equivalent amount of open interest would be a lot higher because it doesn't trade as much as SPY, right? So open interest volume, options volume, it's relative to specific stocks. And what we want to do is figure out, was this increase in open interest large for, relative to a specific stock? So what we do is, first, I'm just going to set that I'm looking for at least 1,000 contracts or more to increase on that option contract. And I'm also going to create a relative, I need some kind of relative metric to make sure that that's a big open interest for that stock. So here, what we do is compare it to the average daily volume. So in other words, if on average a stock trades 2,000 contracts per day on average for all the option series combined. So if you see open interest increase by 2,001 on one line on one contract, that I would say that's pretty significant, right? Because you're talking about just one option contract, which is and that's equivalent to all the option contracts combined. So here we have it set to right now at least 50% or more of the average daily volume. Okay, I'll show you kind of what that means. Like here's a stock, ACRE, that showed up on our scan. So it was up 2.6% yesterday, closed at $14.95. And on average, there's 236 option contracts traded per day in ACRE using the last 90 days. So let's see what happened on this particular option contract. So we're looking at the Feb 18, 2022 expiration, the 17.5 strike, and it's a call. All right, so this is what we see here is we're looking at a longer dated option that is a call, and the strike price is above the current stock price by a little bit over $2.50, right? So an out of the money call. We see that option closed yesterday, mid-market 28 cents. That was up 8 cents on the day. The implied volatility was 22.5. Implied volatility is almost unchanged. There's 1,779 contracts that traded just on this option alone yesterday. Okay, in ACRE, which is pretty significant considering that almost on average, there's only 236 contracts traded per day amongst all those series. So out of the 1,779 volume, right, some of it could have been closing out of previous positions. Some of it could have been people opening and then closing the same day. So what we want to know is like, how out of that 1,779, how much of it increased or decreased the open interest, right? That's what we want to know, how much is still remaining. So here, this tells us that the open interest yesterday increased by 1,285. Okay, so out of the 1,779 volume, 1,285, that increased the open interest. So the open positions increased. People who traded yesterday, a lot of them are still holding that position. And the new open interest is 1,421. So we could see that there's some open interest on that line, but yesterday it increased by a lot, right? So on a relative basis. And we also see, well, if open interest increased by 1,285 contracts, how does that compare to the average daily volume? So that's 500 times the average daily volume. In other words, it would take almost 5 days, if we use the average daily volume, it would take almost 5 days of trading, to trade out of it. Kind of like think of it that way. It's a relative value, okay? So that's what makes it a significant increase in open interest. It's the relative metrics, okay, to this specific stock. And we could take a look at a couple more things before we go to the actual trade. We could see, well, the total open interest in this stock, if we combine all the options, is 6,866. So this 1,421 represents 20.7% of all the open interest, all right, just this one contract. And if we converted it to stock, if all these open interest, okay, if the stock price increased and all of it was exercised and converted to stock, right? How does that compare to the average daily volume in the stock? So the stock trades 647,000 shares of stock per day. Okay, so ACRE, you could see here, it's not a very heavily traded, less than 647,000 shares per day. So if all this got converted, it would represent 22% of what the stock trades on average. Okay, so it's a pretty significant amount. So let's take a look at what happened here. ACRE. I'm going to click on this Feb 22, 17.5 call. And first, we're going to try to figure out what happened and how can we potentially strategize around it. So here's the Feb 22, I'm sorry, Feb 18, 2022 expiration. So you could see here 149 business days to go. This is the longest dated expiration on the board. So we see, they went after this is the long dated option. Here's where it closed, 20 cents bid, 35 cents offer. I'm going to click on this 1779, and we're going to just take a look at what we think may have happened. So here is the time in sales. So we can see all the trades yesterday, the time of the trade, the quantity, the price, where the stock was at the time of the trade, the exchange, and even the trade condition. So we could really paint ourselves a good picture of what happened. Okay, and we see 41 total trades. So it's not one single big trade, not two, but there were 41 different trades. This was the total volume, obviously, about $41,400 worth of option premium. The day before, there was only 136 open interest. So we see how much that increased by. And here we see the prices, the low it traded, the high, and the average. Okay, same thing with implied volatility. Here, I'm just this is by time, so it looks to me like a couple small trades started nibbling on the offer. This traded 25 cents. The market was 15 cents, 25 cents at the time. Then 41 contracts traded, from 10 o'clock. The next trade was 12:55. 41 contracts traded, also bought on the offer. It looks to me then after they bought it on the offer, it went bid, 25 cents bid. Okay. And somebody was selling it at 25 cents, 25 cents. Then it looks to me like that bid got cleaned up. All right. So whatever they put on the book, it looks to me like they left it on a book and then it got cleaned up. Then it actually traded as low as 20 cents. So really, to me, it looks like somebody probably came in, bid 25 cents for it, and actually got filled by the market. All right, so that's how it looked like to me, and you probably could have been buying and selling. It looks like that's where the market kind of determined was the fair value. So having said that, like which side, where do we think would be the better side? When I look at long dated options, and it's really up to you, I'm not telling you what to do. When I look at longer term dated options, I prefer if I could buy them cheaper, because I don't think that somebody selling in a very far term option is cheating, because there's no way of knowing for sure because there's never going to be any news coming out that won't make the stock move. So from that perspective, I think that there's no informational edge there, or informational disadvantage. So if we're looking at a 20-25 cent potentially to buy it there, what would we do here? Well, we got $17.5 strike here. If we buy it, my inclination is, well, can I sell something in a more near-term option to offset some of that premium and create a potentially good time spread? So here I'm looking at the board. I see August 20th, we're expecting earnings somewhere here. And if I go here, I'm just looking at the board. If this theoretically, I'm not telling people to go do this, just sharing ideas. if theoretically you're able to buy that for 25 cents, I'm looking at this 15 strike. So it's kind of like at the money. If you could sell it for 55 cents, maybe there'll be some demand prior to earnings. It is trading at 50 cents, as high as 55 cents. If you could do that time spread, the idea is, well, if the stock remains below 15 bucks at this expiration, maybe earnings are not so good. Maybe, maybe just like remains there or close to there. If these expire worthless, so you kind of got that call for free, right? You bought it for 25 cents. You sold this for, like, say, 55 cents. You collected net credit. If it's below 15 bucks at expiration, well, you keep the 55 cents. That offsets your 25-cent purchase. Plus now you got some credit, and now you got about whatever days remaining, for potentially the stock to go up higher, or maybe you do another, you roll to another time spread. But that's kind of like really quickly, without analyzing the stock further. That's one way of doing it. Of course, if you do that time spread, you sell this for 55 cents, the stock goes up, it goes up to $16, $17. This one will be a loser if it breaks through 15 and goes up. But if you own that 17.5 strike, you're stopped out. All right. So you're doing like a diagonal call spread in this situation. So all I'm doing here is taking a look at how things are trading. Where do I think, if I wanted to participate, it's trading kind of in between the markets, closer to the bid at this point. If it's 25 cents, if you could get it here for 25 cents, which theoretically you're looking at maybe a small theoretical edge based on the bid-ask spread. And if you could get this one off, somewhere in between, you got a small theoretical edge, and you might have a good time spread. We still don't know what will happen, but again, that's one potential. Then you move on to another trade. So does that make sense to everybody? Kind of what we think transpired here?
Yeah, someone was asking, can you plot out a time spread like that?
Yeah.
And actually, I think Jake talked a lot about the theta curve, and in his opinion, this is how he likes to look at
right
doing the time spreads as well.
Okay. Yeah. So the idea is, the idea is here. This is 35 cents. So when I click on this, it automatically populates 35 cents. Should probably, what, I'm gonna probably loosen this up so you could change the prices. But let's say 35 cents. You come here in August, 15, you sell it at 45 cents. So if we did it at these prices, so this is assuming you're doing it at the worst available prices, you're paying 35 cents instead of 25 cents, and you're selling it at 45 cents instead of the 55 cents that we want to, right? So here, based on this, it's a 10 cents credit. Based on our thesis that we could get it better, right? Based on where the prices are trading, we think if we could get it better, by 10 cents on each side, then we're looking for a 30-cent credit instead of a 10-cent credit, okay? Maybe even 25-cent credit. So here's how it would look. If the stock just collapses at expiration, right, you keep that credit, right? And remember, you still have a call remaining, right? So not only do you keep the credit, but you still have a call remaining there that could potentially, you have a lot of days still to go for that to go up. It needs to go up 2.5. Now, we're also long Vega because we're long the longer dated option, short the shorter dated option. So there's another way to win is if volatility goes up. So let's just say, here's what it looks like. Now you are stopped out. Remember that, you're already stopped out around, down here between whatever it is, the distance between the strikes, because you own the 17.5 strike. But let's say implied volatility goes up. So let's test that. And I'm going to just take all this up. I'm going to say the implied volatility, right, in Feb 22.5, let's say goes up to 30. So I'm going to change this to 30. I should have just typed it in. So let's say it goes up to 30. I'm going to reload that strategy with 30. So you can see here, this whole thing shifted higher, right? So that's how it would look. Okay. So that's kind of like the idea behind it. Okay. That behind the time spread. So you're long Vega, you're long the outer term, you're short the near term. And I did this as a diagonal. So remember what we did here was we bought a higher strike, but we sold the lower strike. That's why this looks this way. Okay.
Hey, D, we have some questions from someone who may be who's flipped over to the Zoom. You want to allow a person to talk?
Yeah.
All right, here we go. We'll give it a try.
Okay.
Hey, Jake, can you hear us?
Yeah. Hey there, Dimitri, right?
Oh, hey, Jake, how's it going?
It's a surprise guest. Surprise guest.
Yeah.
I'm really cool, and I really enjoy this this open interest stuff and the options. I had a question for you. So I get what you're doing. You're financing that back end call, that back end open interest, that 17.5 strike, by selling something on the front end, right? The question I've got. So you're doing it to either take in a credit or not spend any money, right? You're selling the front bit, and you're using that to finance the back bit, correct?
Yeah, and that's only because this is the way the options are kind of setting up here in front of me. So I'm kind of looking at the board and trying to figure out, well, what can I do? Because if I'm going to August, right, or even maybe September, there are no bids on any of the higher strikes. If obviously if there's something on a 20 strike or 22 strike and I see things trading, I would start considering those. My only option here, is the 15 strike in this scenario. And to me, it looks decent enough, right? I would look, none of these trades you would ever want to load the boat on, right? Like,
yeah, sure. This is hypothetical.
It's a hypothetical, right? If I, would I do some of it? Yeah, I'd probably take a look if I could get it off. I would probably do it there hypothetically. Maybe I'd still research a little bit the stock just to see if there's anything else going on that I should be aware of. But hypothetically, yeah, what I'm doing is saying, okay, this call looks pretty good. It looks to me like it was a good volatility because the stock volatility, is on a 52-week average is 36, right? So if it's 36 and I'm looking at buying, a 22 vol in the long term, I'm getting a relatively good deal here. These are pretty good. One thing to me, and this was the only thing that, I didn't mention what's concerning is the way these options are lining up. It looks like it's a hard to borrow. And for some reason, there are people who think that there's a better chance the stock might go down because they're trying to borrow to short it. And that's why when I looked at it initially, I'm thinking, okay, I would probably do a spread that leans a little bit short, like this, just because of the way the option, not knowing enough about it and the way the options are lining up. So these are just kind of like through my things that are going through my head if I have to do a quick analysis.
Any reason why you do that time spread as opposed to, for example, a risk reversal on the just using the 18th of Feb 22 expiry, buying the calls and then selling twice as many at a lower strike on the put side?
Right. So one reason, so what Jake is talking about, if I'm buying this, why not sell this, right? The 40.
Yeah, that's what I'm saying.
Right. So this actually, yes.
It sounds like your voice just went underwater. You may want to maybe step back or unplug your mic and plug it back in.
Is this better?
So Let me hear you again.
Is this better?
Nah, it's still you're underwater.
You guys can't hear me?
Well, I can hear you, but it sounds like you're below sea level. It's very choppy.
Let's see. How about now?
Let me hear you again.
Can you hear me?
Yeah, I can hear you. That's a little bit better.
So the risk reversal here in this situation, the way it's lining up, I kind of don't like it because it's hard to borrow situation. When you're talking about hard to borrow, this could keep going and the puts could keep getting, even without the stock kind of going down, you can start seeing, the demand for short and these puts can keep climbing. And for me, if it's hard to borrow, it'll be hard to hedge with the stock. In other words, hedge with the stock, I would do it. But the market's indicating to me that I might not be able to locate or borrow the stock to short, and then what I'll be stuck with a delta position that I might not want. Okay?
All right. Well, it's 9:30. Unfortunately, we weren't able to get back. We could hear bits and pieces about the risk reversal and hard to borrow. D. Maybe tomorrow we can talk about that more in depth. Jake, awesome job coming on. Really appreciate it, brother. Thank you so much.
No problem. I enjoyed it.
Awesome.
Thank you,
Dima,
Jake.
great job.
All right. Well, thanks everyone for joining. Stay safe out there. Have a good trading day and hope to see you guys tomorrow.
All right. Trade in peace, everyone.